Hey everybody, this is Patrick. Thanks for taking a look at the YouTube channel. I haven't posted about the value area breach or break strategy in a while, but I decided to go ahead and make a video here today. I want to talk about Friday. It was particularly interesting, and I still follow this every day. This is a simulator, so hypothetical data, please bear that in mind, and obviously we have the benefit of hindsight here. But it was a particularly interesting Friday, and I want to show you why. So on the NQ, you look right here, you can see there's a buy signal. There was a two-lot trade. And if you look at the corresponding bar on the other market, so my crosshair is right here, it's a globally set, so you can see that same bar on the other charts. The other markets were really nowhere near their value area. And given the bullish sentiment in the NQ and its ability to become an outlier very quickly, like it was here, I decided to put a two lot on. And it was really early in the morning. It was before 5 a.m., which is a little early for this strategy. But given these conditions, I decided to take it. So that two lot trade goes on. I'm going to turn the crosshair off for a moment here and scroll us forward. These charts are all linked by scroll position, so they're all going to scroll forward. And you can see that the market kind of shuffles around a little bit, and then it ends up coming up. Now, one of the great things about this strategy is when you get into a long position and you get a sell signal, because that means you're in a winner. Right? It means the market has gone up through the value area high, and you're up. So a couple things happened here. Number one, I want you to shift your eyes to the Russell a little over to the right here. A few bars earlier, right here, I got a buy signal in the Russell that I took. So I'm already long a 2 NQ at that time. I buy 1 RTY. All right, that's the new Russell contract. It's gaining a lot of steam at the CME. And that one ended up getting out right here. So this was actually a much better exit comparatively than my NQ, which I'll explain in a moment. But this long position contributed to my mentality on the NQ, and I'll explain how that happened. All right, so if we go over here back to the NQ, the market ran up. Right around here, I bought a Russell contract. So now I'm really thinking things are going higher. They do. I end up taking off one of my NQs and putting a stop in right up here, which was a huge mistake. That's something I really advocate against doing because you use a stop that tight on the NASDAQ, you're going to get taken out all the time, and you're always going to forego the ability to catch one of these. So because the market stopped me out and because of how quickly the market, I was just watching it and things were really cranking. There was a lot of volume coming through. I decided to put another one back on here at 59.73, which would have been a great trade had I been willing to risk more on it, and I just wasn't. And I'm not really sure why I didn't want to risk more on it. Maybe it was because I wanted to make sure that I was going to end up with a positive dollar amount or something. But I ended up taking myself out way too early, and I missed the runner. So it was still a winner. It's just not a big winner. And it really should have been a better trade. So I think there's a couple lessons here. Number one is you really want to constantly be looking at the other indexes to see where the outlier is. A lot of times right now it's going to be the NASDAQ because of all the tech stock volatility. So bear that in mind when you're making your decisions. Obviously the market is very bullish right now. We're all waiting for the correction, blah, blah, blah. I've been hearing that for a long time and it could still be coming. But you have to bear in mind the reality of a bullish market, and that's what drove the decision-making process here. So look for the outliers. Bear in mind the current state of the market. And in terms of the stop loss, if you are in a winning trade and it's up a couple $100, put the stop at break even if it makes you feel better, but don't put the stop at break even plus 25 ticks, okay, or 20 ticks or something where you're going to get tagged out right away because you'll never catch this one. And you need to catch one of these every now and then to pay for the losers. All right, so still a valid strategy. Obviously, I'm constantly looking for ways to fine tune this. Crude oil has been pretty, much less relevant lately since it's been running up to $50. I might consider taking this off my screen for a while. But I think this is a cool strategy because it combines profile style trading, meaning looking at the value area high, point of control, that sort of thing, in combination with a traditional indicator like the CCI, which usually doesn't sustain a 200 level for very long. So it's a valid strategy in my eyes. It probably needs a little bit of tweaking as well, but it's very contextual. And there are times where sell signals look like buys and buy signals look like sells. So if you want to discuss it or have a meeting about it with your group or have questions, feel free to contact me. If you want a copy of the file, you're welcome to have it. Certainly appreciate your interest, and we hope it helps out a lot. So let us know if you have any questions. Thank you.